Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's episode, we're joined by Jorge Vazquez, co-founder of Greystone Investment Group, based out of Tampa, Florida. Jorge and I are going to talk about his real estate career. He's been in the business for 20 years now after starting his professional career in financial advising. Jorge realized that his clients were excited about real estate and wanted to help his clients achieve their goals through real estate investments. We're going to talk about when you should invest for cash flow, when you should invest for equity, and how to diversify your real estate investment portfolio. Now let's welcome Jorge Vazquez. All right, Jorge Vazquez joining the Westside Investors Network podcast. Jorge, thanks for joining.
Thank you. Thank you for inviting me.
So Jorge, for people that may not have seen your content before, because I know you're very, very prevalent in the space, you have a number of different articles and research that you have published and shared across the internet. Who is Jorge Vazquez?
Oh, thank you for asking. Jorge Vazquez is a former financial advisor that had a lot of clients under wealth management that I was advising into buying stocks and stuff like that. And but a lot of my clients said to me, let's go into real estate, because they knew I was doing real estate. And I moved from advising, helping clients build portfolios of stocks, to helping people build portfolios of real estate properties. And I've been doing that for 20 years. So I'm a former financial advisor that moved from advising to doing real estate. So I've been doing that for the past 20 years. And I've made every mistake you could think of. I sold 100 properties to one client in 2010. I've had fires. Some of my properties have had murders. And some of my properties, anything and everything that you could think of, I've encountered. And hopefully, through those mistakes, I'm able to help you at least on the areas of the things you don't want to do.
Well, and that's another reason that I'm excited for our conversation today, Jorge, is because you have experience doing using a lot of different investment strategies, whether it's fix and flip, buy and hold, certain types of purchasing, creative financing, subject to all those different things. What do you like the most when it comes to helping clients or yourself invest? Is it a buy and hold? Is it a fix and flip? What do you like to focus on?
Well, that's an amazing question. I think a lot of people don't know what they don't know. So a lot of people come to me and say, well, they've heard a terminology, they've heard the BRRRR strategy, they've heard house hacking, but until they can know themselves, they will not know what matches their financial profiles and or their long-term goals. So when I'm talking to a client, it's like, okay, what are you trying to do, my friend? What is the real goal? And surprising enough, most people don't have a goal. Most people don't have a short-term goal. Most people even less have a long-term goal. So I start always with that. What is your long-term goal? Is it income? Or do you want to flip properties forever? You want to continue that guitar, play music gig forever because you just enjoy flipping properties, or you want to create an empire with rental properties, So I call them, you want to create franchises, right? That's how I see rent. So it really has to match the goal. I always tell people you have to know the last property you need to buy to know the first property you need to buy. There has to be a correlation between the last and the first. I can't just say, hey, what property? I think you should, without knowing what your goal is, without knowing your age, without knowing, are we plugging any type of gap on income? What are we doing? Is this for legacy? Until I know that, I'm not able to say what type of strategy we need to do. But for instance, if the person says, I have $50,000, I have zero money, or I have $50,000, then my advice is going to be house hacking all day long. That's how I went from 0 properties to my first 10 properties. If you marry, it's a tough discussion with the wife. That's a super tough discussion. So you have to promise a castle towards the end. You have to say, hey, honey, sit down with her, grab her hand and say, listen, we're going to jump around. But I promise you the last one's going to be your castle, what you want. So, I mean, so it depends on the profile of the person, depends on how much cash they have, and it depends on the goal. So in a case with somebody with super ambitious, young, with little money, I'm going to say, let's do house hacking. Somebody with more money, I'm going to say, well, let's forget about the cash flow. Let's focus on equity-rich properties so we can do the burst strategy and build momentum. Somebody with a ton of money that they have just, millions, then maybe as a private lender will be better because it's completely passive. So it depends on the person, it depends on the goal, on what they're trying to do long term.
I like that. And that's your financial advising background coming out. You're not just looking to churn and burn properties and close deals. You're looking to help your clients long term and achieve their goals, which is great.
I think that a lot of people look at real estate like real estate. But when you start presenting it to them as this could be your 401k, this could be your retirement, this could be your legacy, then it becomes more vivid. They know, okay, I understand what I got to do. So through the ups and downs, because most people get a little bit of knowledge, advice. When they work in corporate America, there might be an in-house advisor that says, hey, pick this mutual fund or, stay diversified. We have all heard that the word, stay diversified, buy stocks, bonds, buy large caps, small caps, keep it diversified. But when it comes to real estate, nobody knows. They just know they need to buy properties as a primary home. But beyond that, they're clueless. So, and I believe real estate is the fastest way of building a retirement, actually.
And that actually kind of leads me to a question. And when it comes to, like you said, everyone hears diversify, and they're usually hearing it wrapped around their 401k, mutual funds, bonds, stocks, all that stuff. What does diversifying in real estate look like? Wow. And that could be two different parts, right? Like diversifying with real estate is obviously diversifying from stocks. But I'm talking about someone that wants to use real estate investment, their portfolio as their legacy, as their 401k, as their retirement. How would one go about diversifying within their real estate portfolio?
You know what? Nobody has asked me that question, but that is an amazing question because I've asked myself that question. But you have different ways of diversifying. The easiest one and the most obvious one is short-term rentals versus long-term rentals. Okay. Mm-hmm. You got everybody and their mom and their moms investing in short-term rentals, flooding the market. The people that don't even know what they're doing. They've never held long-term rentals. They're jumping into short-term rentals. People don't understand a short-term rental could be almost a foreign stock. It could be a small cap. There's a lot of risk on a short-term rental. Everything has to go well. You have the cleaning has to be done on time. You gotta please the guest. It's not a tenant, it's a guest. So to me, when it comes to portfolio of risk, long-term rentals, it depends on, once again, your profile. If you're super young, go 80% short-term rentals, 20% long-term rentals. If you're near retirement, I will go 80% long-term rentals and 20% short-term rentals if you want to be brave. Because once again, long-term rentals, you set it up, it's a franchise, you collect your money and it's done. Short-term rentals is still kind of like you're still in the business operating it, kind of. So that's one way of diversifying. The other way is you could do you could buy properties and also be the lender. You could do 80-20. Once you accumulate enough properties or cash or equity from your properties, then you could become a private lender, of course, in first position only. So that's another way of diversifying. But those are the two ways that are the most, to me, the better ones. I don't even like flipping, to be honest with you. I've seen a lot of disasters, even with seasoned people with flipping.
Yeah, and I like your comments on short-term rentals. I personally, with my wife, have talked and thought long and hard about getting into the short-term rental space. We only have long-term rentals right now, and it's honestly, I don't want to say it's easy because it's not, but once you get it set up, it's a lot less stressful and a lot less work than short-term rentals, even though you see people on the internet talking about how much they made from short-term rentals and yada, yada, yada. But the risk profile in that is just not something that I've been comfortable with. And I think, when someone is looking to diversify, it may be the different investment strategy, but it can also be a different investment location, area, I guess, single family versus small multifamily, those types of things. What are your thoughts on different areas or locations as a form of diversification rather than just short-term, long-term?
Absolutely. That's another way of diversification. But going back to short-term rentals, think about it. Here's why short-term rentals are so risky. You're going to put so much money into them. You're going to furnish them. You're going to put the nicest quality of everything that you can. So the only option you have for a short-term rental is a short-term lease.
Mm-hmm.
You don't have a plan B in case that the property doesn't rent. Now the mortgage is too high because you bought a very nice property and you're stuck with it, right? There's a chance that you can't even flip it because you got to get rid of the furniture. But with long-term rentals, you always have the option of renting it, flipping it, and whatever the case might be. When it comes to geographic location, I own 40 properties. I'm in Tampa, Florida, but I have properties in Jacksonville. So I don't believe that you have to buy properties next to you because that just narrows down too much your options. And it's not about you. Your investment should not like you. You don't have to like the investment. It's not for you. Doesn't have to be your street. None of that. It has to make money. It's what it has to do. So I think, to me, Florida's big enough where I keep everything within Florida. I haven't had the need to go outside of Florida. But as prices go up in Florida, I will definitely look at Georgia or the next state over that I want to invest in. But yes, absolutely. It's all about the number. It's all about the return. And boots in the ground is just another equation within the risk. How many people do you have a family member that could be boots in the ground just in case for you? Do you have a trustworthy vendor or property manager that could be boots in the ground? And then that equates to a risk percentage, but it's always good to diversify for sure.
And Jorge, let me ask you, what are you looking at when it comes to your portfolio at this point in your career? You own 40 different rentals or 40 units. If you have a deal come up, what are your criteria that you're looking for now if you're going to add a deal?
I'm not flashy. I lost my butt in 2007. I'm just going to be honest. I lost all of my properties, my marriage, everything in 2007. So when I restarted again, I was like, I'm going to go slow. Here's the misconception, or I hear a lot of gurus saying, become super rich quick, buy 300 properties quick. At the end of the day, just freaking enjoy the ride. Take your time. Don't go too slow. Don't go too fast. But for me, I just want to build 2 or 3 more properties a year. I want to make sure but before I buy, there's a specific, what do you call it? A specific status, you can call it. My portfolio has to have very low vacancy. My portfolio has to have certain requirements, let's call them, for me to keep buying. But I pace myself. I don't go super fast, so I can see I will continue finding value-added properties. I think that what happens when you've been in the business on and off, you already have better vendors. There's nothing more beautiful than forced equity, because it's real equity. The equity that you're sold in a narrative, because this is a better property than the other one. I don't believe in it, but I do believe that if I'm putting a new roof, I'm gonna get equity on it. If I'm doing painting the property, I'm gonna get equity on it. So I really like properties. I'll go with the worst property that I can swallow. The worst property that I could feel that I could rehab. That's usually the best investment plan for me. Maybe 10 years from now, 20 years from now, whenever I own maybe 100 properties, whatever the case might be, maybe I'll go and become a lender. But I'm having fun with it, and it doesn't feel like a job. So my advice is pace yourself. You have to like this thing.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
And do you have metrics that you look at in terms of cash on cash return numbers, or I guess appreciation numbers that you're projecting, or do you just want the deal to pencil and cover itself?
When a client comes to me and says, I'm sold, Jorge, I just want to build a portfolio, I ask them, what type of property are you looking for? Are you looking for more equity, or are you looking for more cash flow? Well, I want both. Yeah, I want. Yeah.
So does everyone.
But you have to pick, in order to create momentum on your strategy, you gotta stay in a lane, right? And that's so hard for them to hear. But at this moment right now, because I own multiple businesses that got the properties have allowed me to have a pretty decent lifestyle, and I own property management company, a construction company, like 4 or 5 different a brokerage. I don't need the cash flow now. So to me, a duplex, fourplex, it's not sexy. I like single family homes right now because I'm looking for fast equity within the next, 3 to 5 years. Okay. Because here's a paradox. A lot of people go into multi-units, and then I ask them, what is the purpose of, well, because of, lower risk. Well, I don't believe that. There's not a economy of scale until you have centralized management. In order to do that, you need 100 units. Anything under that, you really have one bad apple on a fourplex, one bad plumbing issue in a fourplex, they all get affected. So there's not the economy of scale that people talk about, and the type of tenants you have in a multi-unit, which most of the time are there on a transitional basis. They're not as good as a single family home where your tenant's going to tell their friends, no, this is my house and nobody can tell me otherwise. You have that pride of ownership. So, but yes, I look for single family homes that could build cash flow right now because I don't need the equity. And think about it, Trent. I like to invest on the high end of the low end. That's what I call it, okay? That means in areas that are going to get gentrified soon. And here's a tip, okay? This is the secret. How you know that is a whole bunch of bad properties, but on the ends, you have brand new properties. So you got a couple of people that have been brave enough to say, like a sandwich, like, this area is next. That's how you find an area where to me, it's the high end of the low end. And I want to be able to share that wave of appreciation against the best comp as a similar property and be able to increase because inflation is going to take care of the rents, right? You don't have to worry about the appreciation of the rents. That's going to happen with inflation. The equity, well, you got to buy smart, because that's the problem with duplexes. The duplexes, fourplexes, they only go up based on the income that is generated. You could have a property that's sold for $1 million next to you, but it's not going to be a comp to your duplex. So you lose that. You lose and the retail buyer is the one that, quote unquote, the most foolish, right? The one that pays overpriced and stuff like that. So you're not, quote unquote, being part of that appreciation wave when you have multi-units. So, but then again, that's for me, because I'm on expansion mode. Somebody that says, Jorge, I got $3 or $4 million, I could care less what the properties are worth. I just want X amount of cash. Then it's the inverse, the reverse. We don't care about equity ever. We just care because equity can mean taxes going up too. We just want, in that case, then we just go with multi-units, Section A if we have to, where all we care is about what the cash that we get today. That makes sense a little bit?
Yeah. And so I'm not familiar with Tampa or Florida markets all too well, but in Florida, for example, where you're investing, are you still able to get a decent cash flow, or I guess are the single family houses able to support themselves while they're appreciating?
Yeah, I will say that a couple of years ago, people come to me and say, for the past couple of years, people said, can I get a property that's hitting the 1% a month? And I will say, no, there's no way. You either take the equity or not. Now, because of the little hit that we gotten, because of the Fed's interest rates, insurance, the perception about hurricanes, et cetera, it's become more of a balanced market. So in one end, you have savvy investors saying, this is still pretty good, because the roof is not on fire, I could promise you, and properties are rented. But there's still some panicking sellers that bought properties without really not knowing, and they're just hearing just bad news. So you're able to still spot deals where you get very close to the 1%, where you kind of like get the cake and eat it too. So you get in the 1% and you're also building up equity. Because anything you buy in Florida, after COVID, Florida is taking more citizens than any other state in the United States. So that's +2 + 2 is 4. So no matter what the market does, there's a shortage on inventory, and then you have more people coming in. And then on top of that, you don't have very low inventory. I think in 2007, when we had the collapse of the market, Tampa had 25 months of inventory available. About 25. Right now, we don't even hit maybe 6. In a balanced market is 7. So we're not even in Florida has gone through the worst of the worst. Anything that you could throw at Tampa, at Florida, has happened, from hurricanes and everything else. So that's the resiliency of Florida is pretty good. So yes, you could find close to the 1%, but what I tell investors, once again, hey, if you have limited cash and you're looking to do the best strategy, forget about the cash flow. Just get properties that you for sure are gonna build up on equity, and then the rent's just gonna go up. The rents in Florida for the past 10 years double. They're slowing down now because they're plateauing now because they went up too quick. But within the next few years, that acceleration is gonna come back again. So the question you're gonna ask yourself is, do I have 50 or 100 in equity to be able to cash out and do this thing? And rates, by the way, can only go down too if this government is able to push the Feds, which I think they will, to lower them. So it's going to be a win-win situation. So that's how I feel about it. that make sense?
Yeah, no, absolutely. And I think you made a good point too with the speed that everything shot up in over the last 5 years, whether it's rents or values or whatever. Florida is taking on so many new residents that there's going to be a shortage. I don't think it's possible to build houses, build units at the clip that's needed in order to get to a balanced, inventory level for just citizens, not necessarily just buying. But Florida is a state that everyone's talking about right now because of how many people are moving there, both for the weather, the economic policies, the business friendliness of it, whatever it may be. Florida is a great market to invest in. Now, I've looked at deals in Florida. The one thing that I struggled with, wrapping my mind around, because in Portland, Oregon here, we have caps on how much, property taxes and stuff like that can go up. We also have rent control, which makes being a landlord difficult. But
Oh, wow.
in Florida, I mean, your guys' property taxes and insurance can just go whatever they want, right? Like they can 300 times year over year if they wanted to, right? There's no cap, or there's no, I mean, it seems like it's a mystery box when it comes to insurance and property taxes in Florida. Correct me if I'm wrong.
Yeah, you're absolutely right. In theory, they could go to the sky, but in practical purposes, they don't. That's a misconception. If you look at the past 10 years, there's usually 1 or 2%. And if you go back 20 years from now, it's only 1 and 2% in average. We've had a little bit of a boost in the past 5 years, but in average, I mean, when I was in Tampa here, when I first arrived to Tampa 30-something years ago, property prices they were like $50,000, $60,000 forever for 5-6 years. Then we have a little bit of a bump in the 2000s, 2005 to 2015, and then it dipped again, where taxes and insurance went down again. Insurance in Florida has a lot to do with fraud. People think that it has to do with the hurricanes. Zero. Hurricanes have been coming to Florida forever, since the dawn of time. The reason why insurance policies have quadrupled is because of fraud. A lot of fraud was happening with sinkholes, where somebody will come to you and say, yeah, I could get you $100K if you let me do a claim. Only if I see a crack in one of your walls, let's do a claim. That's what happened in the early 2000s. That was nipped. New legislation was created, and that was put away. But recently, as of before 2002, there was lawyers. I had a lawyer that came to me and said, hey, you own 40 properties. Can I get you 50,000 times 40, can I, and I said, how are you going to do that? Well, the last storm we had, I said, well, I didn't have any damages. It doesn't matter. So the type of fraud that we were having when it comes to roofs, that's been nipped too. As of 2022, new legislation doesn't allow you to sue insurance companies just on a hunch. You have to have proof. There's a direct correlation between the storm and what happened. And I could tell you, you heard in the past year, the hurricanes that came through Florida, right? Well, 40 properties, knock on wood, no damage. Managed 300 properties, knock on wood, there was only a couple. And the claims were rejected. So when you start asking, like, why are these people increasing? I mean, now, if your property is on the water, it's on the water. That's different. But for those that are buying long terms, that's hardly ever the case that we're buying properties on the water. So I do believe that the insurance companies are starting to recuperate from all of the fraud, really, and they're going to start coming back into business. My policies went up 400%. Imagine you owning 40 properties and they go from like $100 a month to $400 a month, couple of years. I was like freaking out, but I'm happy to report that we're almost back to normal. So you gotta do your due diligence. You have to get your 4-point inspections. You gotta get all of your credits. You have to battle it. There's a lot of if I were to analyze 100 homeowners insurance policies versus, what you have on as a coverage versus what the bank is required, there's a huge discrepancy, but people don't bother to do it. And for perfect example, if you only owe $200,000 on a property, why you have a $500,000 coverage policy? Well, because my property is worth $500,000. Well, your lot is worth $200,000, and then building it, calculated $200 a square feet, 250. You really only need 200. And I could tell you that managing thousands of properties for the past 20 years, I've never had a claim being approved more than $10,000. So why are we covering $500,000? Does that make sense to you? And then I started going through the policies, and do you know that you're paying extra money for leaky sink? So there's a lot of stuff within the policies that people don't know about. So if you're very surgical with that, you can save a lot of money. And also when it comes to taxes, people don't know that at the bottom of the bill, it says, hey, you could dispute this bill, and you got to dispute it every year. You can't compare your Tonka type of repair, type of rental, which you're doing, I call it the Tonka thinking, which is just durable and cheap, versus the flip that you saw next door to you with brand new countertops and everything else. So, but you got to be proactive with that. But yes, so I believe if you're proactive with those two, and the fact that rents continue to creep up, long term you're fine in Florida on anything you buy.
And it sounds like Tampa is the place to be for Florida investment, right?
Well, I'll tell you why. We're the city of champions. We have the Buccaneers, the Rays, we have the Lightning, we have the Yankees in the summer. I mean, we're such an underdogs. I mean, we're a bay. We're so cheap compared to California, compared to San Francisco. We have a lot in common. We're more cheaper than Orlando, Miami. So, I mean, Florida overall has been the underdogs of the United States. And I think Tampa is the underdog of Florida, if that makes sense.
The only difference is it's way more humid in Florida than it is California.
Yeah, I mean, you got to give and take. It's a give and take. So,
and you guys got gators down there.
Yes, exactly. I'm not gonna diss your state, but I got a couple of things that I could say.
I'm a big fan of Florida. I'm a big fan of Florida.
Oh, okay, cool. Yeah, I mean, it's just listen. The last property I bought, $180,000, 3.2. Tell me where can you find that in California? You see what I'm saying?
Maybe a studio condo somewhere.
Yeah.
Well, Jorge, I appreciate you conversing with me and joining the show today. Is there a place where people can hear more from you or connect with you?
Yeah, absolutely. They could go to greystoneg.com. greystoneg.com. I'm obsessed with writing articles. We're the #1 website in Tampa. If you type Investing Tampa, we're #1 out of even big brokerages, stocks or real estate. We're the #1. So you can look us up. I write a lot of content into the website. I think 2 or 3 new articles on a weekly basis. I love it. So you guys could go to greystoneg.com or Google Investing Tampa or top investing companies in Florida. You'll find us.
Awesome. We'll make sure we link those in the show notes. Jorge, thank you again for joining us today.
Thank you for the time. It was an honor. Appreciate it.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.